analyzing Amazon's earnings report, key takeaways, and future outlook. Despite surpassing expectations with its recent financial results, Amazon's future looks uncertain, casting a shadow over its current achievements. At a recent conference, Amazon CEO Andy Jassy addressed these concerns amidst a backdrop of falling stock prices, which plummeted over 7% in after-hours trading. This decline occurred during a discussion about the intensifying competition in cloud services and the heavy financial toll of advancing artificial intelligence technologies. In a detailed breakdown of its financial performance, Amazon reported earnings of $1.68 per share, significantly higher than the $1.33 analysts had anticipated. The company's revenue reached a staggering $167.7 billion, again outperforming the expected $162.09 billion. Despite these strong numbers, the focus shifted quickly to Amazon's future prospects. Particularly, Amazon Web Services, AWS, brought in $30.87 billion, narrowly beating forecasts. The advertising sector also showed robust growth, generating $15.7 billion and surpassing expectations. These figures highlight areas of strength, yet they are juxtaposed against a backdrop of fierce competition from giants like Microsoft and Google, especially in the cloud and AI arenas. Jassy emphasized AWS's continued dominance in the cloud market, despite growing pressures. However, the revenue growth rate for AWS, at 18%, lagged behind Microsoft Azure and Google Cloud, which saw increases of 39% and 32% respectively. This is where the plot thickens. While AWS leads, the gap is narrowing, and the race is on to capitalize on the burgeoning AI sector. But here's where it gets controversial. Amazon's guidance for the upcoming quarter suggests a cautious outlook, with operating income projections significantly below analyst expectations. This has left investors uneasy, particularly as Amazon plans to invest up to $100 billion in AI this year. The question arises, will these hefty investments yield the desired transformative results? Moreover, Amazon's advertising business, though smaller compared to its retail and cloud segments, is emerging as a significant player, trailing only behind industry leaders Meta and Alphabet. This growth indicates a strategic diversification that could pay dividends in the increasingly competitive digital advertising market. And this is the part most people miss. Despite the looming threat of economic downturns and unpredictable trade policies under President Trump, Amazon's core retail operations remain resilient. The company's ability to absorb potential cost increases from tariffs shows a robustness that may reassure some investors. As we look ahead, Amazon's strategy and adaptability will be key in navigating these challenges. The company's commitment to innovation and efficiency continues to drive its customer experiences and business growth. However, the road ahead is fraught with uncertainties. What do you think? Will Amazon's aggressive push into AI and cloud services secure its future? Or are these investments too risky in the current economic climate? Feel free to share your thoughts and join the discussion. Amazon AWS misses the mark. Q2 cloud margins shrink. Stock plunges 7%. Earnings breakdown. When a tech giant stumbles, the ripple effects can be felt across the entire market. That's exactly what happened when Amazon's cloud computing division failed to meet expectations, sending shockwaves through investors and causing shares to plummet more than 7% after hours. The results were particularly disappointing given that rivals like Alphabet and Microsoft had just posted stellar performances in their own cloud businesses. So, what went wrong for Amazon Web Services, AWS, and why are people so concerned? Let's dive into the details. Amazon, one of the largest players in e-commerce and cloud services, released its earnings report on Thursday with mixed signals. While the company projected third-quarter sales above market estimates, its crown jewel, AWS, didn't shine as brightly as many had hoped. Investors were left scratching their heads as profit margins for AWS narrowed significantly. In the second quarter, AWS margins stood at 32.9%, down from 35.5% a year earlier, and even lower than the 39.5% reported in the first quarter of this year. This marks the lowest margin since late 2023. But here's where it gets controversial. Was the drop in margins due to increased competition or internal missteps? Ken Mahoney, CEO of Mahoney Asset Management, weighed in, saying AWS is their growth engine, and to see that drop in margin is dropping the stock. The market was looking for further fireworks to take this up back to new highs and beyond. And he's not alone in his concerns. Analysts are starting to question whether Amazon is falling behind in the race to dominate artificial intelligence, especially since AWS hasn't rolled out a standout AI model comparable to those from competitors. Despite these challenges, AWS did manage to edge past revenue expectations, bringing in $30.9 billion compared to the anticipated $30.77 billion, a modest 17.5% increase. However, this pales in comparison to Microsoft Azure's 39% growth and Google Cloud's impressive 32% surge. These figures highlight the widening gap between Amazon and its rivals in terms of innovation and execution. Another area raising eyebrows is Amazon's capital expenditure strategy. The company expects second-half spending to mirror its second quarter total of $31.4 billion, putting its full-year investment around $118 billion. Compare that to Microsoft's announcement of a record-breaking $30 billion spend in the current quarter, and Alphabet's revised forecast of $85 billion for the year. Clearly, Amazon isn't holding back on investments. But is it enough to keep pace? And this is the part most people miss. While AWS accounts for only a fraction of Amazon's total revenue, it plays an outsized role in driving profits. Historically, AWS contributes about 60% of Amazon's overall operating income. So, when AWS falters, the entire company feels the impact. On the retail side, Amazon showed resilience. Online store sales climbed by 11% to $61.5 billion, and advertising sales surged 23% to $15.7 billion. Still, there's growing unease among investors who fear tariff-related uncertainties might dampen consumer confidence. During a call with analysts, CEO Andy Jassy acknowledged these concerns, but noted that demand remains steady for now. We haven't yet seen diminishing demand nor prices meaningfully appreciating, he explained. But he admitted uncertainty looms over how tariffs will ultimately affect the business. Adding fuel to the fire, Amazon has been trimming jobs across various units, including AWS, UX, devices, and podcasting divisions. Headcount dropped by 14,000 workers in the first quarter, marking the first decline since early 2024. Could this be a sign of strategic realignment or a red flag signaling deeper issues? So where does all this leave Amazon? Is the company losing its competitive edge in cloud computing, or is this merely a temporary setback? With big tech companies pouring billions into AI and data centers, the stakes couldn't be higher. One thing is clear. Amazon needs to step up its game if it wants to reclaim its throne. What do you think? Is Amazon still the king of the jungle, or are darker days ahead? Share your thoughts in the comments below. Amazon earnings recap. Stock falls on AI competition and murky guidance. Amazon stock tumbles as investors grow wary of AI competition and murky profit guidance. Amazon, the e-commerce behemoth, has found itself in hot water with investors, despite surpassing analyst expectations for the second quarter. The company's shares took a nosedive, plummeting 7% in after-hours trading on Thursday, following weak profit guidance and ambiguous answers regarding its competitive edge in the AI arena. The tech giant's net sales experienced a 13% surge, reaching $167.7 billion for the quarter ending June 30th, outperforming the $162 billion forecast by Bloomberg analysts. Moreover, Amazon's earnings per share of $1.68 crushed estimates of $1.33. However, the company's operating income projection for the third quarter, ranging between $15.5 billion and $20.5 billion, fell short of analysts' expectations of $19.41 billion, casting a shadow over the impressive performance. During the earnings call, CEO Andy Jassy attempted to address concerns about Amazon's AI strategy in response to competition. His lengthy and broad response failed to convey his personal views on the company's competitive advantage. But he expressed optimism about the widespread adoption of AI. The Seattle-based company's shares continued to suffer, sinking 7% in after-hours trading on Thursday. Executives also tackled questions about tariffs during the call, with Jassy stating that the company had not experienced significant effects in the first half of 2025. He pointed to the strong Prime Day results as evidence that shoppers remain undeterred by the threat of tariff costs. Key takeaways from the call include Jassy's assertion that Amazon has not witnessed substantial changes in customer demand or price increases due to tariffs thus far in 2025. The company is also pushing Alexa Plus as a more capable, action-focused AI chatbot, and is interested in competing with Elon Musk's Starlink using its own Project Kuiper satellite system for internet access. An analyst challenged Jassy to refute Wall Street's perception of AWS as lagging behind its big tech rivals in the AI race. Jassy provided a lengthy response that did not reveal his personal views on his company's competitive advantage in AI, but expressed optimism about the business as AI becomes more widely adopted. As the call concluded, Amazon stock was down 7.4% in after-hours trading, reflecting investor concerns about the company's future prospects in the face of AI competition and unclear profit guidance.